There you go. Perfect. Okay, we're live, and see, I know I have an icon, but I can't figure out how to put the icon on this. So for now, we're just doing the Best of Investing radio show, and we're going to film right now. All right, here we go. Our times are 6:40, 8:40, 8:40, 8:18, and 5:10.
All right.
But yeah. Okay, here we go. Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-host, Mark Hanf of Pacific Private Money, and our special guest who's been on the show before, financial advisor, Roger Gaynor. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during this show. That certificate's not sponsored by the radio station, but by Tan Bella Tannings, along with 2 locations in San Francisco and 1 in Marin. We want to thank them. They've been a sponsor for, at least 2 years now. All right. Roger, being a financial advisor, you want to talk about risk. Teach us all about risk.
Well, risk, I think, is one of the most misunderstood things about investing and money and creating financial security. I've always believed that there is no risk until there is. So if you think back in the 90s, your listeners are old enough for that. We had this thing called the .com.
Yes.
And you could buy anything with .com at the end of it in 1997, 98. So there was no risk in .com stocks then. We know how that ended, though.
I bought Pets.com and Webvan.
Yes, I remember those guys.
My wife wanted me to buy Pets.com because she liked the sock puppet.
That's right. It was a sock puppet.
It was really cool. They had great commercials, but a business plan that couldn't make money.
No.
And then back in 2005, if you bought a house anywhere in the United States, you were going to make money, right? Housing values only went up.
Back then,
but then 2007 and 8 came along, and suddenly we realized there was risk in buying a home. So there's risk out there in a lot of different things, and we tend to forget about this and what can happen if you ignore it. It's the old ignore it.
It'll go away
at your own peril.
Right?
That pain in my chest, it'll go away.
Exactly.
It's that same kind of deal. So if you look, for example, at the stock market today, there are lots of risk metrics that are increasing to levels in some cases that we haven't seen since 29. That's 1929.
Wow.
And others that are confirming kind of where we were back in early 2007 before what hit the fan.
Yeah.
So, but the market went up 400 points yesterday, and the other day, and today it didn't follow through on that, and we see this kind of thing more and more. It's getting very toppy, and by a lot of measurements, there's very little upside left before a correction.
Okay.
And we can talk maybe in another segment about how monetary policy has made things a lot more volatile, and it's kind of like shooting a patient with adrenaline.
Oh, wow.
To keep that heart pumping, and it keeps it pumping and keeps it pumping for a while.
Yeah.
That's the key. And we've had these low interest rates and lots of liquidity and easy credit and all this stuff for quite a long time.
Well, the Fed, didn't they just announce that they're not going to raise interest rates?
Well, that's interesting. Yeah, so this week, that's exactly right. So there were those, and again, I was telling you off the air about my friend who makes money when the stock market goes down. Well, he was buying his, whatever the options are that he does yesterday in anticipation of them not doing anything and then the market tanking as a result. Well, they held steady and the market didn't tank, interesting enough. So you won't make you wonder what would have happened if they had done a rate cut. Would it have gone down? Would it have gone up? Does anybody know what anybody
really
thinks?
It would go up,
in theory, but what does a
theory.
rate cut really mean at this point in the business cycle? It means things are getting bad.
That's exactly. It seems like they're saying, the economy isn't quite as strong as we want it to be.
Yeah.
A lot of times they'll raise interest rates through the roof if they want to curb growth is too much, inflation and all that kind of fun stuff.
Irrational exuberance.
Yeah. So when we get back, we're going to get into a couple of emails that we got. Specifically, one has to do with, it's basically with risk,
Mhm.
could be based on the question. So that'll be very, very interesting to go into. Let's see here. Before we cut to a break, I do want to make a couple of mentions here. One is for Dr. Keith Cooper. He's a dentist board certified specialist who's been placing and restoring dental implants in San Jose for more than 25 years. His patients love teeth in one day, or they call it Teeth Express. For dental implants in San Jose, see Keith Cooper DDS at cooperdds.com. Also make a mention here for Summer Broadway Under the Stars invites you to experience best night ever. Join them in the vineyards of Sonoma Valley for a festive pre-show picnic with the best of local wine, food, trucks, and music. Check them out at bestnightever.org. Mark and I have gone to a couple of the events. They're fantastic. All right. Let's see here. First trivia question. Again, Roger, if you know the answer, do not answer it until we get back. First trivia question is, which TV show did Tom Hanks appear on for 2 seasons? Let's kind of think of how he got his career started. All right, call 888-912-1190. And the way we're going to do this now for the next 3 questions, if you're the first 3 callers with the correct answer, you're going to win that tanning certificate. So which TV show did Tom Hanks appear on for 2 seasons? So it was probably the first 2 seasons that came out. I still remember this, too. Do you remember the show?
I do. I think so.
Okay. Very good.
At least I have a guess. Put it that way.
You have a guess. Okay. Call 888-912-1190. Be one of the first 3 callers with the correct answer, and you're going to win that tanning certificate, which, by the way, is worth over $100. Not bad. You get like 5 tanning treatments. Yeah. And with the sun coming out, want to get the tan on before
Look good all
you get the
summer.
tan on. That's it. Exactly. All right. So when we get back, we're going to have a email question for Roger that discusses alternative investments compared to traditional ones. All right. Stay with us. If you're listening to The Best of Investing, don't touch that dial. We're going to be right back. Okay. Stretch that out just a little bit. Okay. All right. So we're going to save this. So next one is 840. Okay.
Now, when you say 8:40, that's 8 minutes and 40 seconds as the second.
Correct.
Okay. I was trying to figure out what those things were that you were kicking out there. All right. So these are the longer segments.
No one knows what we're talking about half the time.
Well,
That's kind of making
that's true, but I'm just trying to understand what we're doing here.
That's what we're
Let's
doing.
see. 1 second. So, my phone's like that.
I'm having problems with my voicemail thing. It's crazy. I don't even know a phone
FP.
call comes in.
I didn't know it was Frank Paul. I just knew it was FP.
I know. Yeah, he's going to maybe help us out like on the sports thing and then on the business one show too. Remember
Frank
FP?
Paul is his brother RuPaul.
No, remember FP Santangelo, the baseball player for the Giants?
Oh.
You remember him?
I know.
He played back in the late 90s, I think.
I think it was the 90s.
Yeah.
He was a candlestick guy.
He was.
I don't think
he was-
RuPaul played baseball.
I'm pretty sure you're right.
Pope, or maybe Pope Paul.
RuPaul, that's right.
Okay. Are we ready?
Paul, RuPaul, Frank Paul.
So now I'm just going to come here around 3, right?
Yeah, and then since we're going over the Richmond Bridge, maybe I'll park my car like over at Home Depot, and then we'll just that way they can drop
Okay.
me off.
Okay.
So I don't have to go down to.
Oh, yeah. Yeah, that makes sense. I have to rethink all this traveling.
It is.
Okay.
So you got the question for him. Then there were some general topics you want to talk about. You got the questions. I don't have them. So
Well, I didn't have any specific questions, but there was some good stuff about not losing money. that you
Right,
wanted
and we
to
can
get
talk
to.
about the math of recovery, if
Okay.
you drop.
Yeah, and that thing about
20
the $12 trillion thing that you were talking about today. There's
$12 trillion of bonds that are floating around the planet with negative returns.
Yeah.
And
What's wrong with those people?
think about that.
Yeah.
Think about that people are willing to take a negative rate of return and tie up their money.
You know what? They can just give it to me.
There you go.
Yeah.
I'll give them 0.
Gee, Pacific Private Money's paying more than that. I'll bet.
Are you paying negative more than better than -0?
Better than negative.
Bigger than negative, yeah. Okay, here we go. Welcome back to The Best of Investing. Edward Brown here along with Mark Humph and our special guest, Roger Gaynor, who's probably going to be joining us like once a month, which is awesome.
Nice.
First trivia question, which TV show did Tom Hanks appear on for 2 seasons?
Was it Living Color?
No.
No.
It was the one where he
Dressed up as a woman.
and
Bosom
then-
buddies.
Bosom buddies.
Bosom
that was
buddies.
it.
That's right.
Okay. I thought he was a comedian back then.
Well, he was funny in it. I can't remember the other guy, but yeah, Tom Hanks definitely did quite a career. So, Roger, we're going to ask the email question that came in, and then you've got some information about $12 trillion that I think the audience would like to know about. So, email comes in, it says, other than traditional investments, what other investments should I be looking at? Which kind of goes up the alley if you're talking about risk.
Well, yeah, that's a great question, especially right now, because so many of the traditional investments like mutual funds that are based in stocks, bond funds, we talked about bond funds last time I was on the show, and the risk that's building in the bond market. So a lot of the traditional assets, in Wall Street, they call it crowding. Too many people can't stand in the same place, right?
Okay.
And because it gets things out of whack. So with our clients, we're looking in other spaces. Right now, we're looking at, for example, an investment in trailer parks, mobile home and manufactured housing. These are wonderful cash generators. You have diversified income streams, thousands of people are renting spaces. And so you're fairly resistant to recessions. That's really what I'm looking at now, is sometime in the next 2, 3, 4 years, maybe sooner, we're going to see a downturn in this economy. And I don't think we'll get to all of the reasons why today. So you want to be looking at things that are going to be doing okay when things get rough.
Now, would you look at income opportunities or growth opportunities?
It depends where you are in your life cycle. If I'm 45 years old and entering the peak earning years and I'm bringing home a great paycheck, and what am I investing for? Retirement. I got 20 years to go. You're investing for growth more than income there, because income might add to your tax burden and other things. So,
well, as Kevin O'Leary says in Shark Tank, I'll steal this line from him. I'm interested in cash flow. Always want cash flow.
And at the end of the day, it's all about cash flow.
Yeah.
Okay. So absolutely, cash flow is critical, and it's critical when you're evaluating investment opportunities. That de-risking, you can see it happening in the stock market today. Over the last 6 months since the beginning of the year, we're seeing a rotation. For example, tech stocks are only up about 4% year to date. There's a couple of exceptions to that, like Microsoft, but consumer non-durables, Procter & Gamble, those kinds of companies are up 16% year to date. Utility firms, utilities who are generally pretty staid, they're up 20% year to date.
Well, when
class.
interest rates go down, those usually pop up a little
exactly.
bit.
So you're seeing this rotation out of financials, out of techs, and into the more conservative stuff.
But
by the professionals.
Still, those are traditional.
You're still in the market,
because,
and
in the market,
in 2008, everything did go down So I would suggest to your listener that they look at things that do well in late economic stages. You guys have a fund that is probably in a good position at this point, because you're collateralizing these debts, these loans. But even if real estate drops 25%, they've still got collateral.
Well, let's move on to Mark on that. We'll get back to you because I still want to hear about the $12 trillion. But Mark, what do you comment on that?
So Roger was talking about de-risking, and it's interesting because we talk to a lot of people who own real estate, right? And many are of the opinion that real estate prices are cresting. Is a soft
I think
way
that's
to say
a good word.
And if you own real estate and you believe values are cresting, and you're concerned about do you want to hold it through the next cycle, your real estate? And of course, many people will, right? There's no necessarily reason to sell. It depends on how much leverage you have, and depends on what the cash flow situation is like. But there are those who are contemplating, maybe not, in fact, actually more than contemplating, a lot of our investors in Pacific Private Money Fund have sold real estate over the last year, or are in the process of readying real estate to sell, because they believe that now's the time to cash out, because it's the property that they're holding is probably not going to be worth more than it is today for maybe the next several years. So if they believe that, one of the ways that you can de-risk but still be invested in real estate to a certain degree is to convert from real estate equity to real estate debt. And that's what we offer at Pacific Private Money is we offer real estate debt investment opportunities. So real estate debt, depending on the loan to value ratios and the type of loans you do and the type of borrower you service, can be extremely conservative and can be designed to withstand cycles in the marketplace and as well as dips in valuation, as much as 25-30%. Some of the loans in our fund, for example, are at 50% loan to today's value. Many are higher as well, but the weighted average loan to value in our portfolio of California, mostly California mortgages, is about 60%. So it's designed to withstand and make it through the next cycle, yet still pay out a relatively predictable and consistent yield, which right now on a trailing 12-month basis has been about 7.5% on a distributed basis. Just for more information about the Pacific Private Money Fund, we do the accounting monthly. We make monthly distributions. A lot of funds pay out quarterly. We pay out monthly. That gives you an opportunity, if you're a growth investor and you don't need the income, you can have your distributions buy additional shares, and that's called growth investing, and that compounded yield right now gives you anywhere from 25 to 30 basis points more, meaning we're at about 7.8% compounded yield for our growth investor. So it's a nice way to take advantage of your real estate profits. Now, of course, when you sell real estate, there's tax issues. Now, you can't 1031 exchange into our fund, but for those of you who believe that maybe capital gains under a Democrat administration might actually be taxed higher, that's another thing to consider. Sell now, capital gains tax rates aren't horrible. They're not as high as they have been in prior administrations. So anyway, long story short, real estate debt should be strongly considered if you're looking for an alternative way to earn above market returns and yet potentially pad yourself against real estate cycle risk.
Okay. And when we come back, Roger wants to make a comment on that. Mark, how do people get a hold of you if they're more interested in the fund?
Website's pacificprivatemoney.com. That's pacificprivatemoney, all one word.com, or call us 415-883-2150.
Okay. All right. And when we get back, Roger, you're going to make a comment about that, and then we'll get into the $12 trillion.
The $12
trillion question.
There that we want a piece of.
Yes, exactly. All right. Here's our second trivia question. What breed of dog is Scooby-Doo? All right. Remember Scooby-Doo? What breed of dog is he? Call 888-912-1190. Be the first three callers who get that correct answer. You're going to win that tanning certificate. It's again, the trivia question is, what breed of dog is Scooby-Doo? Don't touch that dial. We're going to be right back. All right.
I dropped my pen.
Always have an.
Oh yes, I found it. It got stuck in my glasses.
Remind me tonight. One of the things I want to mention when we do our presentation is that I called Beta to find out. This is the CPA firm who audits us. I wanted to find out. Do you guys, like, as part of your audit, like, do you check title report like I did? Right, and they do. So when we say that we have $200,000 on XYZ house in Burlingame, they actually do check the title report to make sure
the lien's there.
Yeah.
Good idea.
Exactly. Yeah. But and it's so funny because I kind of tease this on I'm not being necessarily serious about this, but do you ever own Vanguard funds? Vanguard's a fine company, right?
Fine company.
How do you know when you get this big prospectus, they have, $1 trillion in there and they say they own, 1 million shares of Facebook? How do you know?
There's a certain leap of faith to all that.
There's a leap of faith, yeah. And I'm not saying that they don't, but the auditors would have to
they
verify.
Did own them that day. You don't know if they owned them the day before the print.
Oh, no, I don't even know that. Just because it's on paper.
Yeah, well, we used to call it
Bernie
window
Madoff used to
dressing.
put things on paper. Here, see, look what you own. Again, I'm not challenging them at all.
Yeah, no. But window dressing, you don't know
I know
how
about
long
window
they
dressing,
owned it because they're not disclosing
And
it.
that's exactly.
They only owned it that day.
True. But I guess I'm getting. Wouldn't that be that'd be a good movie, right? Some mutual fund that's got $4 trillion basically, and you find out they never owned anything.
Well, there's a guy here in Marin County, you guys probably know him, who sponsors little real estate partnerships up in Novato. I think he used to be a CPA, and I've had clients come to me, and he's got a pool, and then you can make direct investments. And I've had clients bring me his stuff, and I say, well, go ask him who the auditor is. I'm the auditor.
No.
I swear to God.
Really?
And he goes, if you don't like it, don't invest with me. And I'm like,
I mean, I've never, I mean, listen, and I'm not challenging.
And I tell people, if you're comfortable with that, that's your, I'm not going to recommend you.
Well, because I know Ken, and I've never heard of any impropriety, but
he's got a great reputation. But
absolutely. But that being said, it's probably a good idea to have an independent third party, just because.
It covers everybody.
Yeah. I actually had not heard that.
I can show you the email that he sent back to my client because I said, these are the questions you want answered.
Yeah,
and
please.
If you're happy with the answers.
Please send that. I'd love
and he emailed her back and said, I'm not going to answer any of these questions.
Wow.
He said, you either want to invest with me or not.
Yeah.
Wow. It's like, really?
Although I get that.
I mean, I
you get it. You get someone who. It's funny. We've had prospective trustee investors send us an email with 20 questions, and they've got all of $50,000 to invest, and it's like you have to politely decline.
Right. Sometimes it's just not worth it.
Yeah, that's right.
But I know when a client, when somebody comes to me with certain questions, that they talk to somebody else.
Yeah, exactly.
Okay, and it's like you didn't come up with these questions yourself, but I know it, so I know that the answers are going to get reviewed, and I act accordingly.
I mean, I do think it is kind of important to have a third party independent because I'm saying that sort of politely.
Well, like I tell clients, if any advisor ever tells you to write a check in their name, run, don't walk. I mean, everybody wrote a check to Bernie Madoff.
Did they really?
Yeah, they didn't write it to his RIA. They wrote the checks to Bernie. He said, just make that out to Bernie Madoff.
I had a situation when I used to do financial consulting. Some lady, she was brand new into the investing scene because she had got divorced or something or inherited something, right? And at the time, I think it was 100,000, which was a lot back in the 80s, right? And she just kind of like, I gave her a list of things that I thought she should do, and well, do I just write the check to Edward Brown? I go, no. I go, yeah, I'm trustworthy, and that's fine, but no, understand you never write a check to the advisor. Yeah. Okay. Here we go. Well, welcome back to the Best of Investing one more time. I'm Edward Brown, your host, along with Mark Hanf of Pacific Private Money and financial advisor Roger Gaynor. Second trivia question was, what breed of dog is Scooby-Doo?
Is it Great Dane?
Yes, he is. Very good. There you go. Right? That was Shaggy, by the way. Okay, so Roger, you wanted to, we had to cut off to break. You want to make a comment about what Mark had said and then get on to the 12 trillion.
What had I said anyway? Well, that was a long commercial break ago.
You were talking about a lot of your savvy real estate investors are looking to de-risk right now, that they're thinking that valuations have peaked, and I would tend to agree with that. I talk to a lot of people in commercial real estate, and it really seems like valuations are peaking or even sliding back a little bit right now.
Or maybe you are an apartment owner and you're really just not so sure of all of these
rent control
and tenant rights and all this stuff. In fact, Santerfeld, we can talk about that a little bit later. Santerfeld, I read the paper this morning.
That was passed,
you have to just cause eviction, which makes it, again, puts the onus on the landlord, not the tenant, which is really anyway. There's a lot of reasons to sell real estate.
Well, and
regulation,
and you're,
pricing.
You're seeing apartment valuations. Since you brought up apartments, the cap rates, the amount of income that you can take off of these is really at historically low levels.
We had one little tidbit in there too. What happens when you have to do a lot of repairs and maintenance? How much have costs gone up?
No, not at all.
Yeah,
construction costs.
Materials are 30% higher than they were
Yeah.
just a year ago. Yeah, labor's higher if you could find labor.
And if you're the apartment owner, you don't generally have triple net leases with apartment tenants.
No.
So that's all on you. Yeah.
I'm sending a lot of clients back to their homeowners insurance agents to verify the replacement cost
Oh,
per
yeah.
100 per
Yeah.
foot.
Right.
Because around here, they're showing $250, $300
No,
a
Not in
foot.
the Bay Area.
You can't even build a garage for that kind of money right now.
No, that's true.
So
My tent costs more than that. Okay.
there you go. So
Right,
all I was suggesting, I have a lot of clients right now who are seeing those same peaks that Mark was talking about.
Mhm.
And what we're doing is we're repositioning them through 1031 into more conservative areas.
Okay.
So say you own a warehouse or a building, that has one or two tenants in it. And if those businesses get in trouble, you're not going to get your cash flow.
Right.
So you can exchange into something that has many more tenants or is recession resistant. So
Okay.
things like self-storage units. So you might be in a couple of thousand self-storage units, and in downturns, actually they tend to do better because people are storing more stuff and downsizing and moving in together and stuff like that. I mentioned mobile home parks earlier. 10% of our housing stock is mobile home parks.
Oh, is it that high?
Yeah, it's
Wow.
that high. And we're only putting about 10 new mobile home parks on the market each year. And more than that are coming off the market. So there's a tremendous demand in these things. When you can go into an area, say in Florida, and if you make $35,000 a year, you can own your own home and live there. Medical office buildings, another great option.
Especially
because
for the baby boomers.
well, people get sick, and who's really going to pay the rent? It's insurance companies and Uncle Sam through Medicare.
Yeah.
Okay, so you have secure cash flows. So this is a great time to reposition or to get out altogether. As you mentioned, capital gains taxes are lower. So if you didn't want to go through those 1031s, this would be a good time to take that option.
All right. We've been teasing the audience about this $12 trillion question.
12 trillion.
12 trillion.
Well, and when I opened my computer this morning, I usually review markets on a particular website, and one of the prominent articles that they displayed is that there is now $12 trillion in outstanding debt around the planet that is yielding a negative rate of return.
When you say outstanding debt, what do you mean by that?
These are, what we call it around here, our sovereign debt is treasuries.
Treasury bills.
T-bills, T-bonds,
So bonds,
T-notes.
okay.
And these are sovereign debt issued by governments around the world.
Now, would it be, let's say, like Venezuela devaluing there? Or
No,
is it not that?
Germany
Or
is a great example.
Okay.
Germany, their Bund, the notes that their central bank sells are having a negative rate of return. So it's returning less.
Like strictly the coupon rate?
Right. Inflation minus is basically what.
So you can park it in there for
oh.
safety purposes, but you're going to get less back than you.
You're,
hold on.
guaranteed to have your value erode. Yes.
Okay. Well, okay. That's a little different than like in Japan. Literally, you would have to pay for them to keep the bank to keep your money. So
It's
well,
the
I
same kind of thing.
okay, but it doesn't actually have a negative coupon, right? You're saying after inflation.
Some have a negative coupon.
That's
like in Japan.
In Japan, yeah.
You know, and then some are very, very close.
Yeah, like there was a time when U.S. Treasuries were like that for a very short time, like a few days, when things were just going kind of haywire.
And today, you can get more interest on a 6-month note or bill than you can on a 5-year note.
Okay, so that tells you that interest rates are going down.
Well, it tells you that the bond market is predicting a recession. That's when we have an inverted yield curve is what it's called, where short-term rates. That's why if you go into the bank now, you can find banks offering you 2% on a 7-month CD. So short-term CDs, they're all looking for short-term money because those yields are so high, and people have a tendency not to move the money after the yield goes away.
Oh yeah.
But generally speaking, when longer-term investments are yielding less than short-term investments, that's the bond market predicting that interest rates are going to go down and economic activity is going to go down.
Little scary.
Interesting.
There's usually a delay of 12 to 18 months before it
Yeah.
spills over into stocks and things like
That's
that.
always been kind of the typical 12 to 18 months.
12 trillion. That's just unbelievable.
That's monopoly. That's even more than monopoly money. By the way, Roger, we forgot to give out your information. If people have questions about the 12 trillion or just in general about
Well,
it,
How do I get my hands on some
alternatives
of
or
that?
things.
well,
Sure.
there it is, yeah.
Well, you can go to our website, www.gainerfinancial. That's GAINERFINANCIAL.com.
Okay.
And you can contact us through the website. We also have our blog and podcast up on the website.
Okay.
We'll be actually coming out tomorrow with our newsletter where we're going to talk much more about the specific risks in the stock market. I've never put out a blog post like this in my entire years of blogging. Usually it's financial education, not warnings.
And usually people have to pay $1,000 a month to get on your blog. No, I'm just kidding.
We're giving that away for free.
For free.
Oh,
Woo-hoo! Yeah, it's like these financial advisors, and we'll look at your portfolio for free.
yeah.
Well, Roger, thank you very much for that. Okay, we're going to cut to our third trivia question. When we come back, we're going to ask Mark a question that comes in from an email, from a listener of an email. It talks about the difference between your fund and REITs that are traded on the New York Stock Exchange. Good. That's an interesting question. All right, third trivia question. Which actress played Forrest Gump's mom? Remember the movie Forrest Gump? Who played the actor? Who was the actress who played Forrest Gump's mom? All right, call 888-912-1190. Again, the first three callers with the correct answer are going to win that tanning certificate. 888-912-1190. Stay with us. You're listening to The Best of Investing. We're going to be right back. Okay. Okay, that was segment number 3. This last one is 818. 818.
So it's generally 4 segments.
It's actually 5. The last one will be 5 minutes.
2 short ones, 3 long ones.
Got it.
Oh.
And the segment length is determined by the commercial breaks.
The show, the station gives us specific times, and then from that, we have like a few commercials in there.
Well, yeah,
in fact,
we
the
run
reason
a Pacific Private Money commercial.
Exactly, yeah. And then I've got, a couple of these other ones. But the reason I gave you that is those are the ones we gotta freshen up because the audience has heard those commercials for a long time and they get a little stale. Plus things change,
Short attention span theater.
Yeah. But everybody likes to continue listening to us, right? Right.
Absolutely.
All right. Then do you have a deal of the week? No?
No.
No.
I don't.
Okay.
I don't really.
Got
She can make one
Couple.
up on the fly. Yeah,
Yeah.
I don't.
Okay. Here we go. Welcome back to The Best of Investing. One more time again. I'm Edward Brown, your host, along with Mark Hunt and Roger Gaynor. Third trivia question was, which actress played Forrest Gump's mom?
God,
Sally Field.
That's right, Sally
Sally
Field.
Field.
Laugh is not
I
good.
got 2 out of 3.
Boy, do I feel
Yeah,
dumb.
pretty good. That's okay. All right,
I
Mark.
usually miss all 3, so you don't have to feel so dumb.
My wife will make fun of me when I get home.
Yeah.
It's okay. All right, trivia. An email question comes in. It says, Mark, what are the differences between investing in your fund versus a traded REIT on the New York Stock Exchange?
So a REIT is a real estate investment trust, and there's generally 2 kinds of REITs: those that are not traded and those that are traded. A traded REIT can act much like a stock, meaning it could go down in value below the share price you purchase it for, as well as go up. And so it in many ways doesn't feel like investing in real estate if there's that that potential volatility to the share price. Whereas investing in a mortgage pool fund like the Pacific Private Money Fund, first of all, we don't own real estate in the fund unless we foreclose on a loan, which we rarely do in the fund. But for example, the Pacific Private Money Fund right now is about 50 million in size across roughly 100 real estate loans, mostly in California. And so it's a debt investment option. We talked a little bit earlier in the show about debt investing in real estate versus equity investing.
Basically, you're the bank.
Yeah, so that's exactly right. So think of our fund like a mutual fund of real estate secured mortgages. We don't have car loans, we don't have personal loans, we don't have business loans. They're all real estate mortgages. In California, they're technically called trust deeds, but everyone understands what a mortgage is. The big difference really is a real estate investment trust owns the real estate, and a fund, a mortgage pool fund like the Pacific Private Money Fund, is based on the theory that we lend money out based on a percentage of the value of the property, and we typically solve for 70% loan to today's value or less. And because we're the bank, we're not expecting to lose any money. We're not expecting our share price to drop below the $1,000 a share. In fact, the way our income model works is we price our shares at $1,000 each. That represents money we lend out. We lend out that $1,000 at, say, 9%. That share earns a 9% yield. And then that yield pays the expenses of the fund, and then the profit is paid out to the shareholders. And our average payout for the last 12 months has been about 7.5%. And that's after expenses. That's net to the investor. Another thing to keep in mind, most mortgage pool funds, like the Pacific Private Money Fund, have no load going in or out, meaning there's no fee or offset to your, let's say you want to invest $100,000 in our fund. That entire amount goes to work as soon as we activate it in our operating account. And when you go to redeem your account, as long as you leave it in for 1 year, we do have a 1 year hold, and there is a penalty if you take it out in less than a year. And in 6 years of the fund's life stream, we've never had anybody pull out their money in less than a year, so we've never had to charge anybody that early redemption fee. But after 1 year, there's no fee to pull your money out or a part of your money out, and people do partial redemptions all the time. So again, for more information, go to our website, pacificprivatemoney.com.
Yeah, a couple of other things I was thinking of is the nice thing about not trading on the stock exchange is your principal pretty much stays the same. You don't have to worry that you bought it at $1,000 a share and sold it $900 a share because the stock market went down. The other part is, and maybe Roger can mention this, what are generally REITs paying now? There are some mortgage REITs, I believe, that do trade on the stock exchange, but their yields are probably in the 6% or less range, aren't they?
Yeah, pretty much so. That's about what you can see in a mortgage or a debt REIT today. The thing about exchange traded REITs versus private placement REITs, you don't get the tax advantages of real estate. If you want to own real estate and you directly invest in a non-traded REIT, you get all the depreciation and the write-offs and all that good stuff. So the yield is sheltered partially, if not completely.
Okay, that's owning it rather than being in debt. We're talking about being in debt funds.
But you were talking about traded REITs. You don't get those tax benefits. It's taxed like a stock. Okay, that's the point. Real estate is one of our most tax advantaged asset classes. And as soon as you go to those traded REITs, you get all the risks of being in the stock market, right? If there's a run, and you sort of touched on it, but a lot of times these things trade at a discount to the actual value of the properties. If people are down on the asset class and they just want to run to the exits, you're going to get discounted from what it's actually worth.
Well, that's interesting, because on a traded mortgage REIT on the stock exchange, some people like it because they say, well, I can always call my broker and sell it right away. Well, yeah, theoretically, okay. At what price? We don't know. Might be less, might be more. And so I know that there's been some people who say, well, I'd rather do that than Mark's fund because they're thinking liquidity. However, you don't have a problem with liquidity in redeeming shares for people who want to get out. Go into that for a little bit.
Well, it's designed to be, the Pacific Private Money Fund is designed to be a relatively liquid fund. And how do we achieve that? Well, we achieve it by making types of loans that generally pay off in 5 to 6 months. That's our average turn time for the loans in our portfolio is 5 to 6 months. And we don't have a line of credit on the fund now. From time to time, maybe we'll have small lines of credit because we believe in a relatively unleveraged fund for safety, for added safety and security features of the fund. But a small line of credit also allows one to pay off redemptions. But really, it's the new capital that's coming in and the payoffs. And thirdly, we also sell loans out of the portfolio from time to time. That allows us to re-lend the money out. We do share the origination fees that we earn through our brokerage with the fund members. So it's a 50-50 split of the origination fees, meaning if we make a loan for $1 million at 9% and 2 points, the fund as a lender gets half of those 2 points or 1 point. So there's actually a yield boost to the fund by selling loans. So there's a lot of different ways we can create liquidity in our fund so that when someone has an emergency and needs to redeem their account or all or a portion of it, we can accommodate that.
You know, that's really a good point. You guys designed the fund to be liquid. If you take longer term mortgages and you combine them into a REIT and you add instant liquidity, you've just ramped up the risk. Because what, you know, we talked about this last time I was a guest with junk bond funds. It's the same sort of deal. You have highly illiquid investments and you put them in a liquid wrapper, you increase the debt, the risk on that asset dramatically because of forced selling.
Well, that's what's good about Mark's fund is with the short-term loans, you're also not subject to big interest rate fluctuations. You're not locked into doing low interest rates. I'll tell you what, guys, we're going to cut to our last commercial break. We don't have a trivia question, but when we come back, we've got a couple of deals of the week, kind of explain why people would borrow at the rates that they do from Mark's company. Don't touch that dial. The Best of Investing will be right back. Okay. All right. One segment for 4 minutes. 4 minutes, actually. Just gonna close it out.
Didn't get to talk about the math of recovery, and we'll bring it next
Bring
time.
next time. I always want new
The
stuff
math
coming
of
up.
recovery.
Yeah, if you lose 20%, you got to make 35% to get even.
Oh, right.
If you lose 50%, you got to make 100% to get even. You lose 10, you got to make 25.
Yeah, I give Mark that example that we were talking about going up.
Well,
when
the
you look over
argument-
the 2-year period.
I like that.
Oh,
That
Yeah,
example.
that was a really
Sure,
good
that's Wall Street Mathemagic. We could just do a show on that.
Yeah.
Mathemagic says, you know, the long-term average rate of return is 10% in the stock market. We've all heard that.
Yeah.
And mathematically, that's correct, but that has nothing to do with how much we earn. So how I explain that to a client, if you bought a stock for $100 and you sold it a year later for $200, what's your percentage rate of return? 100%, right? And then the year after, if it goes from 200 back to 100, your loss is 50%, correct? Did you make any money? You started with 100, you ended with 100. But you averaged 25% a year.
Because it went up 100 and then it went down 50.
Ah,
okay.
magic.
That's Mathemagic for you.
I thought that was pretty good.
That is pretty good. Wow.
Okay.
Yeah. So how come my 401k still feels like a 201k, even though I've been making all this money in the stock market?
Right, my
according to Wall
broker
Street
keeps
Journal?
telling me I'm making double-digit returns.
Right. Well, I think that is.
We just don't count the losers.
Yeah, exactly. Yeah. Well, it's like they did that with the Dow Jones Industrial. They started taking certain, like buggy whip companies and stuff. You had to take them out. The weighted average and all this stuff.
Well, and usually they're talking about like the bottom in in 33 to today, and that is way different than the top in 29 to today. And if you go back to 1896 when the Dow was created, it debuted at 65, and so the compound rate of return for the Dow is less than 5%.
Going
back to 1896,
which is theoretically when you should do it from the start. Yeah. It's like the two guys meet up. One guy's got, A's got a horse, B meets him and says, wow, that's a nice looking horse. How much for him? He goes, $200. Okay, I'll buy him. Buys him for $200, puts a saddle on him. They meet up again next week and goes, wow, that horse looks really good now. I'll give you $500 for it. It's great. Okay. And this goes back and forth. He adds a blanket, adds this. Finally get up to, like $1,000. And then next time they meet, there's no horse. Okay, he says, what happened to the horse? He goes, I sold him for $2,000. He goes, you sold the horse? You sold our horse for $2,000? He goes, you idiot, we were making a profit. Okay. Do you want to throw out a deal of the week at all?
I can talk about the types of loans we do.
Yeah, whatever. Yeah. Okay. Yeah.
Because we've got an ad campaign going out to mortgage brokers and realtors.
Okay. You ready?
Yes.
Okay. Rub them eyes good. I know what it's like.
You got to make it through 4 minutes.
Yeah. 4 minutes. Yeah. Then we'll take a nap in the car. Okay. Here we go. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Mark Hanf of Pacific Private Money and Roger Gaynor, financial advisor for Gaynor Financial. Didn't have a trivia question, but Mark, if I'm the audience listening in, you're talking about these great interest rates of 7.5+%. I'm thinking, how can you earn that kind of rate of return? Who would borrow money at that high rate of return when they can get money from the bank cheaper?
Yeah, and people get confused. They go short-term loans. So what does that mean? And so we'll have to explain that so 40% of our portfolio is loans that are brought to us by mortgage brokers and realtors who have a client. And oftentimes, this is probably the most common situation that we get a loan request for is a homeowner, lots of equity in their existing home, and they're moving out of town, or they're moving up, or they're moving down. The downsizing is actually, pretty common right now. People are moving into smaller homes. But in order to buy that next home, they don't have the down payment in full because it's mostly tied up in the equity of their existing home. So what do? Do they sell first and then move to an apartment building or some temporary home and then go out and search for their next home? Or do they have the realtor go out and say, now make offers on homes, but as one of the contingencies will have to be the sale of our existing home?
Sure.
And the realtor goes, yeah, I'm not interested in doing that because I'm not going to make any money. That will never happen in this marketplace. So companies like ours, and actually we're one of the few in California at Pacific Private Money that actually will make loans on owner-occupied residences. Most private lenders, most hard money lenders in California only lend to people buying investment property or buying fixing and flipping. But we are licensed and have pursued a particular business model and we really like this business model because the borrowers usually are really strong and the properties are nice, but the need is very unique. And it's the ability for us to provide up to 100% financing to a home buyer on the property they want to purchase and cross-collateralize it with their existing home. And when we do that, because of all the equity that people tend to have in their homes, we can oftentimes solve for 70% loan to value or even less. Sometimes it's 60 or 50% loan to value between the equity when you combine the equity in the two homes, even though we're doing so-called 100% financing on the target because it's secured by two properties. There's so much equity in the first property that we're usually well below 70% loan to value. Why is that such a big deal? You would think, well, banks should do that. Well, guess what? They don't. Banks absolutely do not cross-collateralize. Ask your banker if they will do that. Ask your conventional lender. Ask your mortgage broker. They will all tell you, no, that's not how it's done. One house, one loan. That's what the industry does. Even though these so-called non-QM lenders, which is really a fancy new word for subprime, they don't cross-collateralize either. The only lending industry that will take multiple pieces of property as collateral on a single loan, on one loan, is the alternative finance industry, also called the private lending, or used to be called hard money. But that industry of alternative real estate finance providers, private money lenders like Pacific Private Money, we're the only industry that provides this cross-collateralization opportunity. Now, okay, so fine. So we have a realtor or a mortgage broker has a client that needs this solution because they don't want to move twice. They don't want to sell their home first. What ends up happening is they only need our money for a short period of time. We help them buy the target. They prep their existing house for sale. Maybe they remodel it and sell it for a profit, which oftentimes pays for our money. And then their mortgage broker or their realtor will help them get conventional financing to take us out. And our loans get paid off because there's no prepayment penalty anytime between, say, 30 days to a year, with the average payoff about 5 months. So that in a nutshell is how we can have a fund that is full of loans that pay off quickly. So for more information, go to pacificprivatemoney.com.
Very good. Roger, one more time, how do people get a hold of you for financial questions?
Sure, they can call our office at 415-331-9030. or they can reach us through the website at www.gainerfinancial.com. And when you go to the website, if you'd like to subscribe to our newsletter or blog, you can let us know through that, and we'll put you on the distribution list.
Perfect. Thank you very much. All right, here's our thoughts for the day. Do not touch. That must be the scariest thing to read in Braille. And why is it that in bed it's 6 a.m., you close your eyes for 5 minutes, it's 7:45, but at work it's 30 minutes. Hold on. You close your eyes for 5 minutes and it's 1:31. Oh, it's at 1:30. I'm sorry. It's 1:30 and never mind. Okay, I blew that one. I have written down.
That was close.
But I'm tune in next week to The Best of Investing. We're going to be discussing, we're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long. Boy, I had it written down. And
should read through it before you
know. Thank you. I had the 30
That's
of
what
all.
they taught
That
me
doesn't
in
make sense.
broadcasting school, at least.
Yeah,
Yeah.
what's that? What about at least you can read it once, so every word doesn't sound like a surprise. What
What is this here? You know?
What am I reading? I can't read my own writing.
There was a funny joke. I didn't say it on TV or say it on this thing, but it was like, "Hey, Sarge, we got a problem here. This woman just murdered her husband for walking on the just mopped floor." And they said, "Well, did you arrest her?" He goes, "No, the floor's not dry yet." I like that one.
I would encourage you to do something about the leg on this chair.
Yeah, I thank you.
Somebody that maybe is a little bigger than me sits on
Well,
here, and they're going to be on the
that's usually
floor.
Bruce, and sometimes he.
Well, you
leans
can
back
see
in it.
this one has a bigger
Yeah.
scoop than the other one. You see that?
You know what I did? I think I changed it last time, and just have to change it again.
Oh no!
Yeah, I got it.
Must have been Rob Spinoza. He does those He-Man triathlon things.
Yeah. No, it's not him. It's Bruce.
Bruce?
Bruce McGowan sits
he
there,
probably
and
just
well, he kind of kicks back like this, and I have to go.
These are not rocking chairs, Bruce.
Yes, exactly. Yeah, they are not rocking chairs. Okay, so I got this. I saved this here. Gonna send this to the station.
Roger, that was fun.
Yeah.
Even though
Yeah, good job. We got to get.
I saw an opportunity to tee you up.
yeah, thank you. No, that was good.
Well, and Non needs to get Roger in an MP3 file.
Right, my marketing guy needs it as an MP3. So when
Yes.
I asked for that, he sent us a link to the page where they're all posted.
Yeah,
They're not MP3s there, or we would have already used it.
yeah. There's so many good conversion things out there, and I know if Non doesn't have one on his desktop, I
Okay.
should have with it. But I convert stuff to MP3 over time. It's just it's just a utility basically.
And do you record an MP4 or do you do it in a different form?
No, I think it's an MP3.
No, I'm talking about video.
Oh, the video. Oh,
Yeah.
I don't know.
MOV.
Yeah, I don't know. Is it an MOV? What is it?
It's probably MP4 since it's Windows based.
But I've got to go for 3. I got cut off. The station wants it. I'm going to try to send this to CMCM, and hopefully they'll put it on. It's all concocted with stuff. It's
Okay, well, let me know when it's on YouTube.
it'll be on. It's actually it's on. It was live, but I'll upload it. I guess if you just. Wait, how's that work?
Yeah.
Okay, if
You're asking me?
Yeah. I'm not 12 years old. I don't know these
I have
things.
tech people for that.
Yeah, exactly. You know what? That's a good
Where's
question.
now when you need them?
Yeah, really. So if it's live streaming, it's on my YouTube channel, but I even have your name on it. So and then I post it to Facebook. Is it
Cool.
Yeah. So if you go on my Facebook page, you'll see
Okay.
it.
But yeah, that's the kind of thing on our LinkedIn, corporate LinkedIn and Facebook page. We'd want to put something like that.
Yeah, exactly. Yeah. So that'll happen.
Great. All right. Well, I got to get back
Hi,
to
boss.
the office. Thank you
Okay.
very much.
We'll see you maybe
Maybe
tomorrow.
tomorrow morning.
Okay.
Good to see you. Take care.
I'm waiting for Kathleen to get back to me. I'm dog sitting tomorrow, and I have to bring the dog to the bank. If
That's-
I'm,
I don't think so,
she
Karen.
said, "Let me talk to Karen." I don't want to walk in and have him. This guy's a little Yorkie, for God's sakes.
No.
He's 15 years old, and he should just lay there.
Yeah,
He'll sniff everybody, and then he'll just sit there, and all the ladies will go, "Oh, he's so
Exactly.
cute."
I think
I keep
I'm
telling
gonna
my
guess you're
son,
right.
this is the greatest chick magnet of all time. If
Yeah,
I'd
it
have
is.
known when I was single in my 20s,
Yeah.
what a chick magnet, and he's a rescue dog. So you first get the, "Oh, he's so cute. Can I pet him?" And then, "Oh yeah, yeah." And he's a rescue, and then you get the
Aw.
and it's like, "Oh man,
Come on.
this takes all the work out of me."
Yeah, exactly. Fortunately, we're all married
Yeah,
now.
take care, guys.
Okay,
All right.
thanks, Roger. Okay, so get this. Get this. Get this. We have just 1 minute to go. Yeah. Okay, so we're taking your car to Home Depot, and they're going to meet us at Home Depot. Is that
I
the
think
plan?
so. Yeah.
Okay.
So
So
call Mom right now. I have a
Yeah.
smidgen of a
oh, you're at AT&T?
yeah.
Yeah, that's
Back downtown.
Yes.
Just like
yeah.
Verizon
Price is
work
good.
at my,
AT&T, yeah, not so much. Yeah, let's do this here. Do that tomorrow.
Mom's not answering.
Yeah, he's probably on his way. You got 15 seconds for that. Put this here.
Hello? Hey, how about we meet you at Home Depot?
And
Right,
that's
so
it.
we're
off
done
for today.
recording. We're just probably gonna hit the bathroom and then jump in the car and